Hello, everybody. Welcome back to Beer and Money. On today's episode, we're going to do the third installment on our taxation conversation. If you haven't checked out the first two, definitely go check those out. We started with, in the 2 episodes ago, just a blanket conversation around tax brackets and marginal versus effective tax rates and understanding what those definitions are and what that means for you and your family. Last episode, we talked about, where you're putting money today for savings standpoint. The whole goal of that is to eventually turn on an income stream when you no longer want to work. And the thing that we all care about is what's the after-tax take home from that. So it's a conversation of how will your money be taxed when you start to pull the money out when you no longer want to work. And in today's episode, we're going to be talking about tax strategies once we've gotten to retirement, where you put your money all along for the last 30 years, right? What are the strategies that you could possibly employ depending on where you've put your money? And so we're going to talk about different tax strategies or tax insights that you could possibly look at doing as well. This is the work that we do for our clients. And this is often not spoken about because really the conversation and the thought process is let's just grow my net worth. Let's grow my assets as high as possible. And I'll worry about the income stream later on. And our thought is we have to plan with the end in mind. Where you're putting your money today allows flexibility and strategies possibly in the future, depending on where you put your dollars. So that's today's episode. So without further ado, let's dive right in. So I'm going to share my screen. I know I keep saying this, but I want to make sure it comes across. If you have not checked out our YouTube channel, definitely check it out. It is going to show the visual side of today's conversation. And we'll put a link in the show notes there on the podcast. So we've been talking about this couple that's making a $400,000 income, right? And the way their current income structure from a taxation is currently set up is this, right? $400,000. Their marginal tax rate is 32%, and their effective tax rate is 20.84%, almost 21%, right? The rule of thumb, and this is a rule of thumb, again, this isn't for conversation around, how much money someone actually needs in retirement because it's so individualized. But the rule of thumb that you'll often hear is, the year before you retire, the very next year when you are retired, you're going to need about 80% of your income prior to your retirement. So that's normally the savings, right? If you're saving 20% of your income to get to retirement, well, then you no longer need that 20% of savings. And so if we look at that from a taxation standpoint, and this is where the thought is you might be in a lower tax bracket in retirement, that may or may not be the case. It really depends on where you land in terms of income the year before you retire, as well as if you think about it, when you retire, oftentimes, the first 5 to 10 years of retirement is normally when you do a lot more spending because you're going to be the most active. As much as I would love to be active the entire time in retirement, and that's my goal, I plan to have my health to the best of my ability to be able to do that. In the end, once you get into your 80s or 90s, you may not be spending as much money because you may not be as active, right? But for today's conversation, let's just say $400,000 of income, 80% of that is $320,000, right? And that means $320,000 of it is going to be taxable. If we put all of our money in that traditional retirement account, even when Social Security comes in, up to a certain amount of dollars coming in, up to 85% of your Social Security can be taxed as well, right? So if we're just going straight examples here of all of our money's come from a retirement account that we have not paid taxes on, that traditional retirement plan, this is really what taxation looks like when we get to retirement. And as you can see, our marginal tax bracket did drop to 24%. And the reason that is as you can see, we only had about $17,000 in the 32% tax bracket pre-retirement, which is why we lowered to a 24% tax bracket in retirement. You can imagine if you're making $450, $480 or something like that, you may not drop to the 24% tax bracket. Maybe you will, maybe you won't. I personally am not planning on making sure my income is going to be at the level where I guarantee that my tax bracket is going to be lower. That being said, in this case, the tax bracket would be lower, and the effective tax rate bracket is 19.65%, right? Pretty much 20% in this example. So $320,000 of income is what they need. And now the conversation is, okay, where have they put their money to turn on this income stream? And we're going to keep it ultra simple for today's conversation, because today's conversation is around tax strategies. So it's not going to be about necessarily the risks of turning on the income stream and how much you can turn on from your assets. It's more of the tax strategies that we're focusing on today. So the 4% rule. For those of you who don't know, go Google 4% rule. It's out there. There's some argument on whether or not it could be lower or maybe possibly higher, depending on when you retire. But the overall rule of thumb is 4%. And what that means is there's a low risk of outliving your money if you distribute 4% of your assets in retirement, keeping pace with inflation. That's what that rule of thumb is. It's really kind of scraping the interest off the top of your assets so that you don't outlive your money. So you've got assets set aside for long-term care type situations, keeping pace with inflation, all of that kind of fun stuff. So let's talk about that for today's conversation. So if we're going to be talking about turning on an income stream of $320,000, what does that look like? Okay. So if we're going to do 4% withdrawal, that means we have to have $8 million of assets, 8 million of assets times 4%, that's $320,000. That's the income that this person wants. And if they're pulling it all from a retirement account, a traditional retirement account, it's going to be taxed at that 20%, and that's their effective tax rate. So as we calculate here, here's what the details really look like. $8 million. Now keep in mind, this is a linear spreadsheet. This is getting 4% every year. Again, this isn't reality. We don't know what this person's going to get. But for spreadsheet math and the tax insights, that's the key, and the concepts, that's the key to focus on today. $8 million kicks off the 320 of gross cash flow. Again, they got to pay the 20% in taxes, so that's just $64,000 that they'll pay in taxes. That nets them $256,000, right? $256,000 per year is their after-tax take-home from their $8 million of assets. And again, you can see the legacy value. It stays at $8 million again because it's showing 4% guaranteed every single year for 30 years. What's crazy to think about is $8 million kicked off $9.6 million of income over a 30-year period of time. $1.9 million in taxes. They only netted 7.68, almost $7.7 million of the original $8 million in assets. From a tax strategy, this is not the best tax strategy you could possibly do because, as you can see, it's a lot of taxes you'll pay on that. So what can you do differently? So I'm going to show an example of, and again, this is not me showing that all of your money should go into this style of an account. This is, again, explaining the tax strategies and insights that you could look at from a conceptual standpoint. Okay, so this is really explaining how stuff could be taxed differently and how you could actually minimize the taxes on the income stream from your assets. So imagine you had $8 million now in a taxable account. And again, you're living off the growth, right? If it's 8 million and maybe the growth is the 4% in dividends, right? And it's the same tax bracket, 20%. So what we're going to do in this second strategy is we're going to do what we call amortize the asset. And I want to be clear about this. I would never suggest that someone amortize their entire net worth to turn on an income stream, because what amortization means is you're going to purposely spend down your money over the next 30 years, just like a mortgage, right? You're amortizing your mortgage so you pay it off over 30 years. Amortization from an income standpoint is you're going to pay yourself as much as you possibly can that will last 30 years. Again, I would never suggest someone do this, especially if their $8 million is sitting in the market, because I don't know what the market's going to do. It could get 4%, it could get 8%, it could get negative 20%. Now there's a risk of outliving your money. But from a concept, amortizing their money, and this $8 million is not in a traditional 401k. This is in your standard taxable brokerage account. What does this look like from a taxation strategy? So as I hit recalculate here, you're going to see something really cool. $8 million, if we amortized it, kicks off $462,641 per year. And you get that for 30 years. Here's what's really cool. You can see their first year is $64,000 in taxes. The same tax bill as the other person that did the interest-only approach that took $320,000 out for an income stream. Well, why is it the same taxes? Well, with the $8 million, and let's just say the $8 million is the basis, right? It's $800,000, and you're only paying for the taxes on the growth. That's why 800,000 times the 4%, if that's the growth you got, that's that 320. So you're going to pay the same $64,000 tax bill. But again, you're spending down your asset. So what you can see at the end of the year, their asset is shrunk to $7.857 million. I'm going to round up, $7.9 million. Whereas in the first scenario, they had the same $8 million at the end of the year. Again, we're just strictly analyzing the tax strategy here. So if we took out 462 in the amortization strategy, and you'll read it as principal and interest on the screen, take out taxes, now you can see our net is $398,641. That's a lot more money than the $256 in the other example, right? That's $142,000 more income strictly because of the tax strategy. You can see they took out 462, but they netted 398. Right? How could this be? Let's go back real quick now. Let's go back to the taxes. So let's remember these numbers. 462, 398. Let's write that down. 462, 398. So we're going to go back to the tax calculator here. And this is what I'm talking about. Where you're putting your money today matters for different tax strategies. So we're going to stay over here in scenario 2. 468. Let's go back. I already forgot the numbers here. Sorry, 462 and 398. So 462,398. What does that look like from a taxation? What's their new effective tax rate? This is what's crazy. 462, 398 of it is taxable. Sorry, only 320 of it is taxable. So you can see we just took the same marginal tax bracket, 24%. We just took their effective tax rate from 20 down to 13.6. That's the power of the different tax strategies and where you're putting your money. That's a huge, huge difference. And if we continue along with this strategy, you'll notice in year 2, the tax bill goes down. Why does it go down? The tax bill in year 2 is $62,859. Same 462 came out. The reason the tax bill goes down is, well, 8% on the $7.8 million, 4% on the $7.8 million is not $320,000 anymore. It's now lower than that, which means you're going to pay lower taxes, which means in year 2, this person's going to get $399,000. And if we stay focused on the net cash flow, 15 years in, still taking out the $462,000 a year, but their net after-tax take-home in year 15 is $419,514 compared to the original strategy of the interest-only strategy of $256. So if we're analyzing the tax strategies here, now look at this. Almost $13.9 million was taken from their original $8 million asset. They paid less in taxes right? I'm going to round up, call it 1.2. So it's $700,000 in taxes. And their take home, what they got to live on over that 30-year period of time, was $12.7 million. That's over $5 million more that they got to enjoy strictly by where they place their money and the strategies that they used. You can see it's a 65% difference in income. Now, again, I'm not trying to say that you should ever amortize all of your assets. Like maybe you do some version of, we've got $8 million, maybe we amortize, and I'm going to make up an example here. Just say $6 million. What does $6 million if we amortize turn on in terms of assets? 346 is gross, and you can see our net is 299. It's still better. Less money, 6 million, turns on more income. Strictly by tax strategies and tax insights, understanding where we've put our money and what's available to us. Okay, so that's tax strategy number one. I want to transition over to tax strategy number two, but I want that to sit in real quick. That is a huge, huge difference. Okay, we're essentially able to control our tax bracket strictly by making sure we have our money in different taxable, tax style buckets, fully taxable, tax-free, partially taxable. And what's the strategy to turn on the income stream, right? Because that also allows us tax savings. So let's take it to the second tax strategy, and that's what I'll end on for today's episode. And I've done this before, so make sure you check out other episodes as well. So let's go to, so we're going to talk about annuitization of a tax of an asset. And what annuitization is essentially it's turning on a guaranteed income stream for you and your family. Yes, it's an annuity. I want to be clear about something on the word annuity. There are so many different types of annuities that oftentimes they all get lumped together. Some are invested in the market, and there are high fees involved in it and can possibly turn on an income stream. Some are what they call a single premium immediate annuity, which is what I'm about to explain today, where you essentially give your money to the insurance company. The insurance company then strokes a check for the rest of your life. Every year you get a paycheck for the rest of your life. I would never suggest that anyone takes all of their money and turns on and puts it into an immediate annuity, okay? And an annuity may not make sense for you at all. But again, we're just talking about tax strategies and tax insights here. And so for today's episode, again, if we're looking at the $8 million, the same $8 million, the same 4%, the same 20% tax rates, and we're going to do an annuity here and do same age 65, 20% tax rate, and we're going to do for a male, and we're going to annuitize the full amount. Again, I would never suggest you do this. This is strictly for analyzing what are the tax differences in the strategies. End of year. So let's take a look at what this looks like. You can see over here in scenario one, that same $320,000 coming out, the same $64,000 tax bill, the same net take home of $256,000. In the annuitization strategy, $8 million would kick off $575,747 per year guaranteed. And you can see the tax bill is only $33,931. Again, this $8 million is not in a retirement account anymore. In the second strategy, this is $8 million that was in a partially taxable account, and you've already paid the taxes on the money, and you're giving it to the insurance company. So I want to make sure you're aware of the differences, right? 8 million in scenario one is all in the 401k. 8 million in scenario two, the annuitization standpoint, this is not in a 401k. Okay. Again, though, the net take home, $541,816. Stop and think about that for a second. The same asset, $8 million, and look at the difference in income, net after taxes. $541,816 versus $256. And just for fun, if I annuitized $4 million instead of $8 million, $4 million would kick off an income stream after tax of $270,908. Now, the way this annuity works, the reason the taxes are so low is there's something called the exclusion ratio, right? You're not paying, you only pay the more taxes. It's based on your life expectancy. So once you've received, you've given your money. In this example, I lowered it 4 million. So let me put it back to 8 just so I can keep it the same for those of you listening just on the podcast. $8 million. What this is looking like is this. An annuity is based on your life expectancy. The reason they can afford to give this person $575,000 guaranteed for the rest of their life is once they die, the money stops coming to them. Okay, now you can do a joint annuity where it's guaranteed to come to you and your spouse, right? There's different styles of annuities and there's different guarantees you can put inside of it. For today's episode, we're just talking about taxation, and I want to make sure I explain the tax differences that occurs later on in life. Essentially, once the insurance company has given you your $8 million back to you, now the full amount of the 575 is taxable, which is why you see it jumps up to $115,000 in taxes in year 21. Because essentially they've given this person back the $8 million that they gave to turn on the income stream. But even still, 460, 598 is way better than 256. These are tax strategies that we can employ possibly depending on where you've put your money, right? Because if your money was all in a 401k, it would still kick off the 575, but we would owe the 115 in taxes every single year in this example. So I hope today's episode, like the point that I'm trying to get across here is the different strategies and where you've put your money today and where it grows allows you to possibly control your tax bracket when you go to turn on the income stream, because you get to do stuff like this on scenario 2 over here. If you can turn on an income stream in this, the 462, back to my original example, but only 320,000 of it is taxable, you just made your effective tax bracket go down by 7% and cut your tax bill by 20 grand. And if you're able to do this over time, because sometimes you can do 462 and sometimes you can get down to maybe 250,000 of it is taxable. And now it's at 10%. Okay. This is where tax strategy, long-term planning, is a huge conversation to have, and it starts today. For those of you listening, I know most of the people listening to our podcast is not close to retirement. However, where you're putting your dollars today allow you for different tax strategies, or maybe doesn't allow for different tax strategies, depending on where you put your money. And so in summary of the last 3 episodes, you're putting money in retirement plans, Roth plans, which is a retirement plan, investment accounts, savings accounts. What does your tax strategy pie chart look like? Is the majority of your pie chart red, meaning it's fully taxable when you pull the money out? We may not want it to be majority green, although maybe you do. But we definitely want some sort of balance so you can kind of control the tax bracket later on. I hope this episode was valuable for you. If you have any questions, head over to beerandmoney.net. At the top of the page is a Contact Us section. In the show notes, you'll have the beerandmoney.net website, as well as there's going to be a link there for you to be able to go do your own financial scorecard. So you'll go to the site, put in some information, and it spits out a scorecard to let you know how you currently look. And if you feel like you could maybe get some value at engaging personally with us, feel free to reach out to us. We started this podcast to help you think differently about your money. And by different, we mean looking at everything: taxes, your protection, your estate plan, the different professionals in your life and the orchestration of that. Because we have found that a lot of times when we sit down with clients, they have been piecemealing their plan together, and they've got all these different professionals in their life, and the professionals don't coordinate with one another. And so they've kind of got this financial junk drawer. We help simplify, clear out that junk drawer, and help you reach the goals that you have for your family. I hope this episode was valuable for you. And as always, cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7505832.1. Expiration date January 2027.